Can we just start with this bond market and this epic rally we've seen over the last couple of days?
Sure. Hi, John. I love the way you set it up for Mike Wilson. The equity market could do no wrong. You have a blue wave, you price in tremendous fiscal stimulus. You have gridlock, you price in tremendous monetary accommodation. It's entirely different scenarios for the bond market. If we had a blue wave and we had the fiscal stimulus, you're talking about yields up at around 1.25%. With gridlock, the only game in town is going to be the Fed, and you're talking about yields going back to about 0.5% and staying there for a long period of time.
Bob, what we're seeing playing out for me is just unreal. The move in the bond market, I can understand that. I think if you told me this is how it would play out after the election, bid into treasuries, I'd get all of that. To see the rally in high yield, to see the rally in triple Cs as well. Bob, what's behind that?
Well, I think there are a lot of things that are behind this, and we'll hear from Jay Powell later today. I never thought, and I've been doing this now close to 40 years, that I would see central bankers one after another begging governments to borrow and spend. But that's what we're seeing. And that keeps economic activity afloat at some level while the recovery continues to progress. And you also have all the credit backstops across the market. So investors are stepping back. They're saying, do I want to invest in government bonds with somewhere between a 0 and a 1% yield? Or do I want to go into corporate bonds? And you look at the U.S., there are still 330 million consumers that are consuming day after day. Sure, we know the problem areas of the market. We know travel and leisure. We know retail. We know some of the property market. All of that will go through restructuring, but there are still large parts of the credit markets that will be okay, that will be money good, and that's where investors want to put money to work. Yeah, I'd like investment-grade credit to yield 4 or 5%, not 2%. I'm not going to get that.
We all would. We'd all like much higher yields than that, Bob. And as you've pointed out many times over the last several years, maybe it's never coming back with the exception of the rout we had back in March. The president's tweeting right now, Bob, and the president is saying stop the count. The count continues, but the president is saying stop the count. The big fear a few months ago was a contested election. I don't see any signs of fear right now, Bob. Why do you think that is? And how do you think market participants will process this if this is the direction of travel for the next several days, maybe even several weeks?
So having lived through all this 20 years ago, a contested election caught us all off guard. Nobody anticipated that. This time, it's been pretty well telegraphed. Everyone accepts that it could be contested, but at some point, all the votes will be counted, they'll be recounted, and there will be an outcome. And right now, the markets are of the view that we're going to have a split government, we're going to have a Biden presidency, and we're going to have a Republican Senate. And I don't think anything's going to shift the narrative away from that over the next few days.
Well, let's talk about the narrative of the next few years and talk about whether the politics is actually relevant here, Bob. You're looking for lower rates, lower trend growth, a trajectory similar to the post-crisis environment of a decade ago. Bob, does anything about what is happening in politics right now change that for you?
Sure. I think we're seeing some of that now. I mean, you touched on earlier that we're seeing Mitch McConnell open the door to negotiations of a fiscal pact before year end and potentially before a new administration. I think that Washington gets it. It's not a 4-year cycle. It's a 2-year cycle. And the midterm elections are only 2 years away. So you have to start doing something. I think you're going to see moderate help. I don't think you're going to see anything of the magnitude of what we're seeing in the UK, but enough to keep things ticking along until a reopening process can happen in conjunction with the vaccine. I think the bond market will like that. I think they'll feel the Fed will play its part. I certainly do. And yields will stay stable.
Bob, I'd like to whip through this price action with you just quickly. We've talked about the bond market. Let's talk about foreign exchange quickly. 9 minutes away from the opening bout for cash equities. Equities are up nicely. We know that story. What is new here is just the amount of dollar weakness flushing through the FX market. And, Bob, I know a big conversation people are having at the moment is how much international exposure they should be putting on at this point. Bob, are you thinking about that a little bit more in the last 24 hours?
Yeah, we are. We've liked emerging market debt for a while because of the high real yields and the aggregate policy spots on the monetary, fiscal, and healthcare side in some parts of the world. When you look at a potential Biden administration, suddenly you start pricing in perhaps more palatable trade negotiations, less severe rhetoric, and more compromise down the way. When we look at countries like Mexico and think of the Mexican peso, it's at 20 now. Sure, it was about 21 before, but it used to trade before the trade wars at somewhere around 18, 19. I think we're headed back there. You look at Indonesian rupiah, it's rallied 4%. It could easily rally another 5 to 10%. So there's a lot of value in emerging markets, particularly in FX, if you have an administration that comes in that will dial down the rhetoric on trade.